If you'd like a free revision checklist that covers all the topics on your course, then do go to the description box and you'll see the link there. Don't forget to subscribe so you're notified when more videos like this are released. One of the main factors that can change the demand for products is the amount of income consumers have to spend. When consumers' income increases, their salaries and wages increase. This will impact on the choices of goods and services they decide to purchase and the demand for these type of goods. For some goods, when there is an increase in average income, perhaps there is a boom in the economy, there will be a greater demand for the goods and services. There are other products that when income increases, there will be an increase in demand, but not a significant increase. In addition, if there is a recession, it could mean that the average income falls, and this would impact on the demand for the goods and services that consumers purchase. Businesses want to know how rises or falls in consumers' income affect the demand for their products. Business managers will look at the relationship between the change in income, whether that's increase or fall, and change in demand levels for different types of goods or services. Income elasticity of demand measures the responsiveness of the quantity demanded to a change in income. It's also known as YED. This is the formula for income elasticity of demand. It's percentage change in quantity demanded divided by percentage change in income. So likewise with price elasticity of demand, you have to calculate percentage change here. Let's take a look at a simple calculation. In a given area in the UK, incomes rise from £500 per week to £550 per week. And at the same time, this leads to a local firm's sales increasing from 1,100 units to 1,400 units. Calculate the firm's income elasticity of demand. You can pause the video now if you'd like and attempt this calculation. Right, so we're going to first of all take a look at the change in quantity demanded, because that's part of the formula. We know that there was a change from 1,100 units to 1,400 units, so that's 300. Now, in order to turn that into a percentage, we need to use percentage change, and that is change over original times by 100. So we know that the change is 300. Divide that by the original amount, that's 1,100 units, and we times that by 100, and that gives us 25%. Let's now calculate the change in income. So we know that there was a change in income from £500 to £550. So that's a difference, that's a change of £50. And we need to divide that by the original and times that by 100. And the original was £500. And that gives us an answer of 10%. So now we have the information that we need to put in our YED formula. 25 divided by 10, and that gives us an answer of 2.5. So that's positive and it's 2.5. When we calculate YED, it is important to know whether the answer has a minus or plus sign. Income elasticity can be positive or negative. Businesses must interpret the sign of the YED figure and the value of the number itself. Now, if there's a negative sign, then it means it is an inferior good, and these goods have a negative income elasticity. When income goes up, demand decreases. When income falls, demand increases. People buy more of this good when their income falls. They are cheap substitutes of products people prefer to buy when their income has reduced, such as store-branded goods. Normal goods have a positive income elasticity between 0 and 1. They have a positive relationship between income and demand. This means that as income rises, the demand for normal goods rises, but at a slower rate than the increase in income. Examples are matches and haircuts. These are normal goods. Now, luxury goods have a positive income elasticity that is more than 1. This means that the demand for luxury goods grows faster than the increase in income. Examples are holidays abroad and sports cars. It's important for businesses to know the effect of changes in income on different types of product. Now, for inferior goods, when there's an increase in real incomes, then there's going to be a decrease in demand and consumers stop buying cheaper substitutes and trade up now they have more money to spend. When there's a decrease in real incomes, then there's an increase in demand for these type of goods, and consumers may switch to these types of products so they can save money as their incomes fall. For normal goods, when there's an increase in real incomes, then there is an increase at the same rate as real income or slower, and affluent consumers are now able to buy more of this type of product. When there's a decrease in real incomes, for normal goods, there's a decrease at the same rate as real income or a little slower. Consumers will start to spend less and they will cut back a little on these types of products. When there's an increase in real incomes and it comes to luxury goods, then the change in demand is that there's also an increase at a faster rate. Consumer incomes increase and there is more of a demand for these types of goods. Now, when there's a decrease in real incomes, there's going to be a change in demand for the luxury goods as it decreases at a faster rate than real incomes, and consumers will spend less of their income on these types of goods as real income has fallen. The main factors influencing income elasticity of demand are whether or not the goods are necessities or luxuries. Luxuries are goods that consumers like to buy if they are able to afford them. These are items that we can live without but like to treat ourselves with when we can afford to. Necessities. These are basic items that we would expect to buy even when times are tight. These are not sensitive to changes in average incomes. It's important to know the significance of income elasticity of demand and how it will impact on businesses. Now, one of the ways is product portfolio management. Some manufacturers have the flexibility to switch from one product to another when they notice a change in income. Others don't. Therefore, it is important for businesses to spread their risk by ensuring their product portfolios contain products with a range of income elasticities. Production planning. If businesses are aware of the income elasticity of demand of the product, they can respond to an anticipated change in income. This could be an increase in the national minimum wage. It could be that there's a boom in the economy. It allows a business to forecast sales, making sure there is significant output. It helps them plan ahead. And financial planning. If a recession is predicted, a firm producing luxury products can plan ways to reduce costs in advance and may even amend their budgets in order to reduce the impact of a fall in sales. Thank you for watching this video. I've put a link to the price elasticity of demand video, which would be a good one for you to watch next.